The main misconception, Andy, is that people want to be able to take the word risk or the concept of risk and use it in a formula to do computations to figure out what are the best possible alternatives and how did people do well in the past in a risk-adjusted sense. So the only number that's available for them to use as a proxy for risk is volatility or the standard deviation of prices or returns. So they do. I think that that's not what risk is. Risk is really, if you think about it, it's the possibility of having an undesirable result. Simply translated, or I should say most simply translated, the probability of losing money. So that's risk. The other thing is not risk. On the other hand, there is no number you can use for that because there's no place you can look to find out what the probability of a bad outcome is today or what it was 6 months ago when you made the investment. So you can be quantitative but not accurate, or accurate but not quantitative. You can't do both.
Shifting gears a little bit, what is your thinking about the high net worth market, both in terms of selling to it and in terms of investors looking for things to buy?
I think that, America is distinguished around the world by the magnitude of the high net worth market, by the number of people who have large amounts of net worth, and the fact that more people are joining that group all the time. So it's a great market, alternative investment firms like mine have the opportunity of selling into that market. The people are historically underrepresented. The institutions did it first, in other words. Things like private equity, distressed debt, private credit, real estate, anything along these lines. So it's a great opportunity. I think that to really do our job right, we have to pair it with education. Educating the consumer is not that easy at any level. And the singular goal should not be to sell products to that market. It should be to educate that market and then sell it the things that are right for it. I'm very interested in education and spend a lot of time on that myself.
But sort of increasing allocations for high net worth individuals could be appropriate given that they have a good understanding of what they're getting into.
Right, as long as you use the word could.
Right.
Could be appropriate. It's not. There's nothing that's right for everybody. People have to understand how to make decisions about how much return to pursue, how much risk is involved, and what's the right risk and return target for them.
Right. You recently wrote a piece where you talked about the difference between ownership and debt and said that was really critical to understanding investing. What do you mean by that, and why do you say that?
Well, people talk about the many ways there are to invest: stocks, bonds, real estate, private equity. I've named a
derivatives
bunch of them.
You mentioned
yes,
as well, right?
Derivatives, currencies, commodities. But really, if you want to think in an organized fashion, I think you should think about ownership and lending. If you want to invest in a business, let's say your brother-in-law says, I'm going to open a restaurant, and I'd like some support. You have two choices. You can say, okay, I'd like to be a partner, I'll take half. I'll put up half the money, I get half the profits. I don't know how you'll do, but I'm going to back you. Or you can say, I'm not that confident that it'll be great. I'll lend you some money, but I want you to promise me that you'll pay me interest every 6 months and give me my money back at the end of the term. And I get paid before you get paid. So my relationship with you is contractual and senior. So that's the difference between stocks and bonds. A stock is a partial ownership of a business with no promise of anything other than your share of what all the owners get, if there is something. A bond is a promise of interest and repayment of principal in a priority basis. If you think about it, the two have nothing in common. They're not, oh yes, well, stocks and bonds, they're a little different. They're both securities and here's the difference. No, there's nothing in common. And for the most part, ownership assets give portfolios their dynamism and their upside potential, but at the cost of being uncertain and having significant downside potential. Lending assets have a fixed promise which is dependable but limited in its upside.
I remember once hearing you say, Howard, there's no bad assets, only bad prices. What do you mean by that?
Well, look, I started work in this business 55 years ago last month, and at a bank, and the banks invested in what were called the Nifty 50, the stocks of the 50 best and fastest growing companies in America. Companies that were so great there was no price too high. Nothing could ever go wrong. And if you bought the stocks the day I got there and held them tenaciously for 5 years, you lost over 90% of your money. Why? Because they were too expensive. It's not what you buy, it's what you pay that determines a good investment. Now, the longer your time horizon, the quality of the thing you buy matters more and the price you paid matters a little less. But still, people have to understand that good asset is not synonymous with good investment. To make a good investment, you have to be price conscious. And so, that's really what it comes down to. It's not a matter of buying good things, but buying things well. And you have to understand that difference, and it's more than grammatical.
All right, that leads me to ask you what you think of the equity markets right now. I know you're not necessarily a big equity person, but are we in a new Nifty 50 era with, say, the Mag 7? What is your thinking about equities?
The easy answer is to say we are, not necessarily correct. You can't make any meaningful observation about assets unless you know them extremely well, and I don't. First of all, Oaktree generally doesn't operate in the stock market, being alternative managers. And secondly, I am not tech savvy, growth savvy. It's just not my thing. So I don't want to mislead anybody. These are prices which on the numbers look expensive. We gauge that by looking at the price-earnings ratio. They have high price-earnings ratios. But, sometimes a high-priced car is worth it and a low-priced car isn't worth it. So low prices and cheapness are not synonymous. I think everybody thinks these are great companies. They may be great companies. They have high PE ratios. They may be deserved. So I don't think people should have a knee-jerk reaction on that subject, and I try not to.
Getting back to the paper you wrote recently, you talked about a sea change in interest rates, and you mentioned the 2009 to 2021 era.
Yeah.
Can you explain that a little bit more?
Well, I start the memo Sea Change December of 22, available to all your viewers gratis on the Oaktree website. And I say that in 1980, I had a bank loan outstanding on a personal basis, and I got a slip in the mail saying the rate is now 22.25. 40 years later, in 2020, I was able to borrow at 2.25. So interest rates went down for me by 2,000 basis points, 20 percentage points. Anybody who came into this business after 1980, that's 44 years ago, so it's almost everybody in the business, has only pretty much lived through declining interest rates or ultra-low interest rates. And interest rates hit their all-time low in the period you're talking about, 09 to 21, which is the subject of the memo. I think the Fed funds rate, which is the overnight rate that the Fed charges banks, got down to zero at the beginning of 09 because they had to fight the global financial crisis, stayed low pretty much until the end of 21 when they decided to raise it to fight inflation. And in that period, the Fed funds rate was zero most of the time, and I think averaged about 0.5%.